If you're in your 40s or 50s and you still don't own a single dividend stock, chances are you've had this thought before. I waited too long. I missed my chance. There's no way the numbers still work. Derek used to think exactly the same way. He's 47 years old, with about $60,000 sitting in a savings account earning next to nothing. Every time he thinks about investing it, he talks himself out of it. He tells himself he'll start once work settles down, once the mortgage is a little smaller, once he's had more time to research, but somehow, that day never comes. His neighbor Travis is almost the same age, same income, same mortgage, same 2 kids, even a wife who works part-time to help make ends meet. The difference? About 18 months ago, Travis spent one quiet Sunday afternoon with a legal pad, ran a few simple calculations, and decided to start. No financial advisor, no complicated spreadsheet, just 3 numbers. Today, Derek is still waiting for the right moment. Meanwhile, Travis is collecting dividend payments almost every week. Same age, same starting point, completely different outcome. And the only real difference between them is that one of them stopped waiting and started doing the math. In this video, I'll show you exactly what Travis figured out that afternoon. We'll cover the IRS rules that actually make starting after 40 far more powerful than most people realize. The little-known REIT tax break that many investors your age completely overlook. And the mistakes that keep people like Derek stuck in analysis mode for years. By the end, you'll be able to run the same calculations using your own numbers, and you'll know whether waiting another year is really costing you more than you think. But before we get into the math, there's something even more important. The first thing Travis discovered had nothing to do with dividend stocks. It was something I call the behavior gap. Once you understand it, you'll see why Derek stayed stuck for so long, and why millions of people in their 40s and 50s unknowingly fall into the exact same trap. In 2022, researchers at the National Bureau of Economic Research looked at when people claim Social Security benefits, and they found something surprising. For most workers between the ages of 45 and 62, waiting until age 70 would produce the highest lifetime Social Security income. In fact, more than 90% of people would come out ahead by waiting. That's not a guess. That's what the numbers show. But here's the interesting part. Very few people actually do it. Only about 10% of retirees wait until 70, while more than 30% claim benefits the very first year they are eligible, at age 62, locking themselves into the smallest monthly check they'll ever receive. That's the behavior gap. It's the gap between what the math says is the better decision and what people actually do. And it's exactly the same thing happening with Derek. His $60,000 isn't sitting in a savings account because investing doesn't make sense. It's sitting there because he's waiting for the perfect moment. The numbers were never the problem. The waiting was. So here's the takeaway before we go any further. If you're 45, 50, or even 55, and you start investing in dividend-paying assets today, you haven't missed your opportunity. You still have 15, 20, maybe even 25 years before retirement, depending on your situation. And dividends don't care how old you are. When you reinvest them, they compound the same way at 55 as they do at 25. Compounding doesn't start when you're young. It starts the day you begin. Now, changing your mindset is important, but mindset alone won't pay the bills. To catch up successfully, you need to understand the rules that actually work in your favor after 40. And that's exactly what Travis discovered on that legal pad. The first one comes straight from the IRS, and it's one of the most overlooked advantages for late starters. I call it the catch-up multiplier. For 2026, anyone age 50 or older can contribute an extra $8,000 to a 401k through catch-up contributions on top of the standard annual limit of $24,500. That means you can invest up to $32,500 in a single year. But it gets even better. If you're between 60 and 63, Secure 2.0 allows an even larger super catch-up contribution. Instead of $8,000, you can contribute $11,250. That increases your total annual contribution limit to $35,750. Think about what that means. While many people in their 50s assume they've run out of time, the tax code is actually giving them more room to accelerate their retirement savings than at any other point in their careers. There's one important catch, though. If your FICA wages were at least $150,000 last year, your catch-up contributions now have to go into a Roth 401k, not a traditional one. In other words, those contributions must be made with after-tax dollars. And if your employer still doesn't offer a Roth 401k, you may not be able to make catch-up contributions until they update their plan. That's why one of the smartest things you can do is send a quick email to your HR department and ask whether your plan supports Roth catch-up contributions. It takes 5 minutes, and it could save you from finding out too late that you couldn't contribute as much as you expected. This is the part Derek completely overlooked. He assumed catch-up contributions were just a small bonus. They're not. If you're investing in dividend-focused funds inside your 401k, an extra $8,000 to $11,000 every year, compounding for the next decade or more, can make a meaningful difference in your retirement income. It's not pocket change. It's additional investing capacity that the tax code was specifically designed to give people exactly your age. The catch-up multiplier determines how much you can invest, but where you invest can be just as important. And this next part of Travis' legal pad was probably the biggest surprise. Most people have heard that REITs, real estate investment trusts, are tax inefficient because their dividends are usually taxed as ordinary income. For years, that criticism was fair. Since REITs don't pay corporate income tax as long as they distribute at least 90% of their taxable income to shareholders, the dividends they pay are generally taxed at your ordinary income rate. But that's no longer the whole story. Back in 2017, Congress introduced the Section 1990A deduction, allowing investors to deduct 20% of their qualified REIT dividends. Originally, that deduction was scheduled to expire at the end of 2025. Then in July of 2025, the One Big Beautiful Bill Act made it permanent. No expiration date, no countdown, no wondering whether the tax benefit will disappear just as you're approaching retirement. Interestingly, some early versions of the bill proposed increasing the deduction from 20% to 23%. That didn't make it into the final legislation, but honestly, the bigger victory wasn't getting a larger deduction. It was knowing the deduction isn't going away. That kind of certainty is incredibly valuable when you're planning decades of retirement income. Here's what it looks like in practice. Suppose you're in the highest federal tax bracket, 37%. Without the Section 1990A deduction, $1,000 of REIT dividends would leave you owing $370 in federal tax. With the deduction, you're only taxed on 80% of those dividends. That lowers your effective federal tax rate to roughly 29.6% instead of 37%. Over time, that's a meaningful amount of money staying in your pocket instead of going to the IRS. I call this the REIT tax unlock. But there's one detail that catches a lot of investors off guard. To qualify for the deduction, you generally need to hold the REIT for more than 45 days during the 91-day period centered around the ex-dividend date. If you buy the shares just before the dividend is paid and sell them immediately afterward, hoping to collect a quick payout, you can lose the deduction altogether. In that case, your dividends are taxed at the full ordinary income rate. It's one of those small technical rules that most people never notice, but it can make a real difference. There's one more thing worth mentioning. If you own REITs inside a traditional IRA or a 401k, you don't claim the Section 1990A deduction at all. The reason is simple. Those accounts already receive tax-deferred treatment, so the deduction doesn't apply there. That doesn't mean REITs don't belong in retirement accounts. It simply means the tax advantages depend on which account you're using. And that's exactly why it's so important to run your own numbers instead of following blanket advice from YouTube comments or social media. At this point, Travis had discovered two major advantages that were working in his favor the entire time. The catch-up multiplier gave him more room to invest. The REIT tax unlock helped him keep more of the income those investments could eventually produce. None of this was hidden. The information was available the whole time. Derek just never took the time to look it up. But even knowing these rules isn't enough if you fall into the same mistakes that keep so many late starters stuck. And the truth is, for most people, it isn't the market that holds them back. It's the decisions they make before they ever give the market a chance. Let's talk about the mistakes that usually derail people at this stage. And interestingly, very few of them have anything to do with picking the wrong investment. The first mistake is treating debt like a moral failure instead of a math problem. Right now, Generation X, the group most of you belong to, carries the highest average credit card debt of any generation at roughly $9,600 per person, according to Experian. If that sounds familiar, don't beat yourself up. The solution isn't guilt, and it isn't waiting until every dollar of debt is gone before you invest a single cent. Instead, compare the interest rate on your debt with the return you realistically expect from your investments. Then allocate your extra cash where it has the biggest impact. That's a financial decision, not an emotional one. The second mistake is trying to own everything. I see it all the time. Someone tells me they own 14 different dividend ETFs, and when I ask why they picked them, they can't really explain what half of them do. More investments don't automatically mean a better portfolio. Start with a handful of core positions you actually understand. Know the role each one plays. Then, if you have a good reason to diversify further, add complexity over time, not before. The third mistake is panic selling. A stock drops, the headlines get scary, confidence disappears, so people sell, only to buy back later after prices recover because it finally feels safe again. That's one of the most expensive habits an investor can develop, and if you're getting a later start, you have even less time to recover from repeatedly buying high and selling low. The fourth mistake brings us right back to the behavior gap. It's treating every investment decision as if it has to be perfect. Derek isn't stuck because he lacks money. He isn't stuck because he lacks information. He's stuck because he believes his first move has to be flawless. It doesn't. It just has to happen. There's another version of this mindset that I hear all the time. If I'm behind, I'll just work a few more years. Now, working longer can absolutely help, but it's not the guaranteed backup plan many people assume it is. According to the Bureau of Labor Statistics' most recent displaced worker survey, workers between 55 and 64 who lose a long-term job are reemployed only about 55% of the time. For workers between 25 and 54, that figure is closer to 74.5%. In other words, extending your career is an option, but it's not a promise. And it's risky to build your entire retirement plan around something you may not be able to control. That's exactly why it's so important to know where you stand today. Not based on hope, not based on fear, based on numbers. So let's do exactly what Travis did. Let's run a few simple scenarios and see what the math actually looks like. Now let's put some real numbers behind all of this. Imagine Travis starts with $50,000 US. He invested in a portfolio yielding about 4%, reinvests every dividend, and continues adding $400 US a month. Nothing flashy, nothing aggressive, just steady contributions and consistent reinvestment. If he sticks with that plan, he's on track to build a meaningful 5-figure annual dividend income by the time he reaches his mid-60s. Not because he found some secret investment, but because he gave compounding enough time to do its job. Now let's change just one variable. Suppose you're starting with $150,000 US instead. Keep the same 4% starting yield. Keep reinvesting every dividend. But now, once you turn 50, you also take advantage of the catch-up multiplier and increase your contributions to roughly $1,500 US a month. Notice what happens. You don't just end up with a larger portfolio. You dramatically shorten the timeline, not by decades, by years. And that's exactly why catch-up contributions exist in the first place, to help people accelerate their retirement savings later in life. Now imagine an even larger starting balance. Let's say $300,000 US. At that level, another factor starts to become much more important. Taxes. The REIT tax unlock we talked about earlier isn't just a nice bonus anymore. Depending on your tax bracket, it can save you thousands of US dollars every single year. And because the Section 1990A deduction is now permanent, those savings can continue year after year throughout retirement. That's money you're already earning. You're simply keeping more of it. So what's the actual formula Travis wrote on that legal pad? It's surprisingly simple. Start with your current portfolio balance. Multiply it by the dividend yield you expect your investments to generate. That gives you an estimate of your first year's dividend income. Next, factor in the amount you plan to contribute each year. Assume those new investments earn the same yield. Then reinvest every dividend instead of spending it. As your portfolio grows, the income it produces grows too. And that larger income begins producing even more income. That's compounding in action. Finally, compare that projected income to the monthly amount you actually want your portfolio to generate. The difference between where you are today and where you want to be tells you something incredibly useful. It tells you how much runway you have left. I call that your catch-up runway. It's simply the number of years between today and your target income based on real assumptions instead of guesses. Instead of wondering whether you're too late, you'll know exactly where you stand and exactly what it will take to close the gap. And if you'd rather not build that spreadsheet yourself, I've made it easy. There's a free Dividend Snowball calculator linked in the description that runs these projections automatically. If you want to go a step further, the Dividend Income Toolkit also includes the 3 scenarios we just covered, along with the catch-up multiplier calculations and the REIT tax estimates already built in. The goal isn't to predict the future perfectly, it's to replace uncertainty with a plan. Because once you can see the numbers, you're no longer guessing. You're making decisions based on them. Let's bring everything together. It all starts with the behavior gap. That's what keeps so many people from ever getting started. It's the same reason millions of workers claim Social Security earlier than the math suggests they should. The numbers aren't usually the problem. The hesitation is, then there's the catch-up multiplier. If you're 50 or older, the IRS gives you the opportunity to contribute significantly more toward retirement. And once you're between 60 and 63, that contribution limit gets even bigger. Instead of seeing your age as a disadvantage, the tax code is actually giving you more room to catch up. Next comes the REIT tax unlock. Because of the permanent Section 1990A deduction, qualified REIT dividends receive a 20% deduction, which can substantially reduce the taxes you pay on that income, provided you meet the holding period requirements. It's one of those rules that doesn't get much attention, but over time it can save you a meaningful amount of money. And finally, there's your catch-up runway. That's simply the number of years between where you are today and the income you want your portfolio to produce. Not based on guesswork, not based on fear, based on your own numbers. Now think back to Derek. He's still sitting on that savings account telling himself he'll start once life settles down, once work gets less stressful, once he has more time, once everything feels just right. But that perfect moment never seems to arrive. Travis wasn't smarter. He wasn't wealthier. He didn't have access to some secret investment strategy. He simply stopped waiting long enough to run 3 basic calculations. 18 months later, one of them has a portfolio that's generating dividend income on a regular basis. The other is still wondering whether he should begin. The opportunity was there for both of them. Only one chose to act on it. And maybe that's the biggest lesson in this entire video. Your financial future isn't determined by the day you were born. It's determined by the day you decide to start. If you want to see which dividend ETFs and REITs can fit into a strategy like this, watch the next video. The best ETFs to live off dividends in America. I'll walk you through the specific funds that many long-term dividend investors use and explain how they fit into an income-focused portfolio. And before you go, let me ask you one question. What's the one number you've been avoiding? Your starting balance? Your age? Your monthly contribution? Leave it in the comments. Sometimes the hardest part isn't building the plan. It's finally being willing to calculate the first number.